In the span of a few months, a single company locked down up to $46 billion in corporate mega contracts. But this enterprise, Nebius Group, which is currently reporting 684% revenue growth, didn't start in Silicon Valley. It was built from the remnants of Yandex, the heavily sanctioned Russian tech giant. To sever ties with those sanctions, founder Arkady Vulish sold his Russia-based assets to a Kremlin-linked consortium for roughly $5.2 billion. He took the remaining international cloud businesses, scrubbed the corporate identity, and took the new entity public on the Nasdaq. Offloading the Russian business for $5 billion cleared the path for a massive re-rating. Today, that debt-free international entity is valued at $66 billion, a valuation built entirely on its pivot to high-end AI clusters and its multi-billion-dollar contract backlog. Right now, the AI supercycle is hitting a hard physical limit. The industry is quite literally running out of available grid power and leading-edge processing chips. This scarcity created the neocloud, a highly specialized cloud provider that ditches general-purpose web hosting to offer exclusively purpose-built AI infrastructure. Nebius's core AI cloud offering is engineered specifically to capture this exact demand. Their primary advantage is absolute vertical integration. They secure power grids, buy land, and hold a priority supply partnership with NVIDIA to guarantee early access to the scarcest hardware on Earth. To fund this massive physical footprint, they hold several highly valuable side assets. The largest is a $4.2 billion stake in the database company ClickHouse, acting as a strategic financial reservoir to draw from as they expand. Nebius operates as a specialized hyperscaler, controlling the entire stack from power grids to software layers, capturing the physical foundations of the AI market. This chart shows Nebius's financial explosion in early 2026. You can see their 684% year-over-year revenue growth, driving their annualized run rate, the projected yearly revenue based on active contracts, straight up to $1.9 billion. This surge pushed their core cloud segment into actual adjusted profitability. But look at this new column appearing on the chart. That represents a $9.3 billion cash reserve, built largely through massive customer prepayments, which completely towers over their actual operating revenue. That deep liquidity profile helped them secure sovereign-level validation abroad. The Israeli government recently selected Nebius to build and operate their national supercomputer infrastructure. In the United States, however, their reach hits a hard ceiling. While they easily secure local tax incentives for giant data center campuses in places like Missouri, the Russian corporate heritage effectively locks them out of sensitive U.S. federal defense contracts. This creates a very specific dual reality. The company is financially bulletproof in the commercial sector, but firmly constrained the moment national security gets involved. Private institutions are heavily backing the commercial thesis. The fund run by prominent AI researcher Leopold Aschenbrenner recently took a $2.6 billion position in the company, validating the theory that physical infrastructure is the true bottleneck in the tech sector. Retail investors immediately followed suit, driving a massive wave of social media momentum that pushed the company's valuation to a staggering $66 billion. Interestingly, there is a total absence of political insider trading here. Current congressional trading trackers show absolutely zero activity from U.S. senators or representatives on this stock. The momentum is instead anchored by massive corporate commitments, specifically multi-year revenue guarantees from tech giants like Meta and Microsoft. Buyers at this level aren't investing in a sleepy, predictable utility. They are buying into a high-momentum narrative that requires the company to execute its build-out perfectly for the next half-decade. Building the physical layer of the internet requires a massive, coordinated effort in power engineering and data center construction, revealing a structural flaw in the company's financial model, the scale of its capital intensity. Look at their 2026 guidance. On the right, projected revenue is $3.4 billion. On the left, capital expenditure sits at a jaw-dropping $25 billion. Bridging this gap requires continuous debt and dilution, leaving them vulnerable to price drops. When compared to direct proxy competitors like CoreWeave, IRAN, and Applied Digital, Nebius commands the richest, most unforgiving valuation multiple of the entire group. They are running a multi-billion-dollar race against the clock. They must secure continuous capital injections and finish construction before any potential pullback in AI spending. And while the public market continues to bid the stock up on the promise of those cash reserves, the people inside the building are quietly rushing for the exits. In a 3-month period, internal executives executed 17 separate sell transactions, totaling $132.5 million. During that same window, there were absolutely zero insider buys. The company's chairman and CEO led these sales, cashing out over $100 million, while the firm was simultaneously raising billions in new capital to fund its build-out. This raises a central question for the industry. Is compute a scarce, high-margin asset that justifies this massive expansion, or will returns compress once the initial build-out cycle ends? Nebius represents a high-variance bet on the physical foundations of the future. It's an infrastructure giant, currently teetering on a high-stakes financial wire.